In here, I was continuing the talk from the last video where I was telling you why, or telling him why, that even though this company's balance sheet on a first glance looks spectacular, it's not. It's because more than 53% of this company's balance sheet is in net intangibles, goodwill, and intangible assets. That is horrible for this small of a company.
Yeah, but if you take the current down, even the current assets, the number blows up to 115 million. So where I struggled was I looked at all this negative stuff, and then I said, "Holy shit, the revenue and everything's increasing. So how the hell is revenue increasing, or how is cash increasing, and like free cash flow and everything's negative?" And it popped into my head that it could be just issuing shares. They're just completely equity financing, which I think, like just in 1 year, they increased the equity financing 115 million. So they issued a ton of shares in the last year.
We're skipping around a bit here, but share dilution is one of the biggest problems you need to watch out for in smaller and newer companies, because it can literally destroy all shareholder value.
And I want to go through that with the statement of the statement of shareholder equity. I noticed that's a new. Is that required, that form? I think it's required now, right? That's a statement of shareholder equity. I thought that was a form that's required in companies now. That I read that somewhere. I think it is 2012. We'll check it out. It's on their 10K, but it basically shows how those shares went from 77 to 119 million.
I was confused here for a bit. He means the consolidated statement of shareholders' equity in the 10K.
Oh, because of the TTM. Yeah, fiscal year. Yeah, trailing 12 months.
Just elaborating more here on their massive share dilution that we talked about in the prior video.
In 2 years, and 115 million of that was common shares. It looks like they bought a ton. If you look at the 10K, they bought a ton of companies, and they issued a share. Check out the 10K and look on page 3. Probably page 4 or 5. It's a statement of shareholders' equity. So that's the income statement. No, keep going down. I'll show you. Keep coming down. It's not too far. Keep going. Right there.
Again, this is the consolidated statement of shareholders' equity in the 10K financial report that should be in every annual report of every company you look at. It tells you where the shares have come from, what they're doing with them, stuff like that.
So yeah, it shows you exactly where the share was issued, how they were issued, and if you look at equity financing, and then there's a lot of acquisitions where they traded shares, I think, for them. I kind of looked at the notes. I didn't really get my head that much around it. But
here's where we're going through the footnotes to see what these acquisitions actually were, how much they paid for them, we found that they were overvalued, which we talk about here shortly as well.
Actually, that's billion, right? No, I'm sorry. You're right. That's million. Because it's in 3 zeros. So you got to add 3 zeros to the end.
So here, not only am I reminding him to be cognizant of which decimal place that is, but this is where we begin going over the goodwill and intangible assets, and how we know for a fact just by looking at these financial statements that they vastly overpaid for their acquisitions, and that is where the massive amount of goodwill and intangible assets comes from on the balance sheet.
Okay. How much was that value worth? Is that the equity over to the right? Or share capital, that's how much it was worth in the next line, in the next column. Yeah. I'm assuming that's how much the share was trading at the time.
How do I know just by looking at these financials that they massively overpaid for the acquisitions? Because it created a bunch of goodwill, which is an accounting term that essentially means you overpaid in terms
At least,
of book value.
I mean, at the end of the day, they started it
You
in
acquired the
98.
company for more than what the entire book value of the company is worth, and that excess amount is what is goodwill. And here we know this is massive goodwill and not good goodwill, because there are
Yeah,
no
they have a ton of acquisitions.
trademarks, there are no patents, there are no huge brand names in the weed and marijuana market at this time in the United States. So that's how we know they overpaid and massively overpaid.
Yeah, it was pretty confusing.
Goodwill right here, 2.3 billion in goodwill.
Well, that's another thing under the con that I put. Goodwill exploded in the last 2017.
Again, what is goodwill?
It's basically the overpayment when you buy a company. It's how much you overpay versus their either market or their book value.
Yes. So their total
To me, it's
purchase
just
price.
it's a
Oh, this is
to,
just one.
to me Goodwill is almost, wouldn't Goodwill almost be a negative because that's cash or some value you're just giving away and you're not really theoretically you're getting an intangible for a tangible.
He makes a great point. This is almost 100% correct unless you buy goodwill, which is called economic goodwill that Warren Buffett talks about when it comes with companies with sustainable competitive advantages, moats, brand names, stuff like that.
Yeah, I was going to say, like all these small cannabis companies, how much goodwill can there be, really, right?
Here's where we dig into the kind of specifics about goodwill and why in this case it's not a good purchase, not good goodwill.
Maybe, I mean, what do you get? You get customer base at the very most. You get a customer base.
And this is a great discussion on what else the intangible assets could be that they purchased. Intangible assets aren't only things like brand name and trademarks. They're also patents, distribution networks, customers, stuff like that. In this case, this is a brand new company. And in the United States, weed and marijuana has only been accessible through medical purposes for 3 or 4 years now, so we can guarantee they don't have significant customer lists.
Well, licenses, I would imagine, too, because your licenses
we
sell
know,
cannabis.
just by knowing the market and this industry in the United States, they massively overpaid for this, and these intangible assets and goodwill are not to be considered assets.
I was going to say, that's just like they just made it, throw it in there to look good.
Again, here I'm just reiterating to him why he made a great point why these should not be considered great assets on the balance sheet. Most likely, and due to their margins and the overprice they paid for these purchases, they'll most likely have to write down these assets on the balance sheet at some point or write them off completely, which would destroy value on the balance sheet. And balance sheet is where most deep value investors start, at least in terms of building their margin of safety. It's where most deep value investors start when they look at their initial analysis of any company.
Well, look at the net assets, though.
Here he makes a point about net assets, and I explained to him why this is not a net current asset value situation, because it's not worth nearly what the price per share or overall value of the company is. Just the net assets are not.
12 million over the 350.
The net asset value in this case was massively below its current share price, I believe by a factor of around 70 to 80%. So even though they have net positive assets, they do not have net current asset value according to Benjamin Graham or other margin of safety valuations.
No, it's going to be less than that.
Here we're just doing a specific calculation to find out the numbers, and so I can illustrate to him why this isn't an NCAV type company, because for that to happen, the NCAV value per share has to be higher than the current share price.
Yeah, basically it's 3.5%. 12 grand is 3.5% of 350 grand. Tiny figure. Tiny.
Again, just illustrating even more to him, showing him the specific numbers, so he gets he knows how not only to do the calculation in the future himself, but also so he can realize that even though, again, this company has positive net current assets, it is not a Benjamin Graham type company. It is not massively undervalued according to that specific metric or number.
Yeah. 27.5 times. And as Munger says, you could count 100% of the liabilities. So we know those liabilities are probably pretty accurate. Cash. Yeah, distribution channel licenses, net assets, branded Goodwill is just junk. It's just throwing that money. Yeah, that's why I don't look at Goodwill. And Goodwill did explode, and that's one of the reasons it exploded, because they're not the only company they bought.
Here we begin to talk about all of the company's acquisitions that they've done and how massively overvalued not only they are in their balance sheet, but how much they overpaid for these acquisitions.
Yeah, and there's a lot of them that they're buying up. Sure. I do.